Welcome, financial adventurers. It's your guide, Iggy the Investing Iguana, ready to embark on another thrilling investment journey. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with a total of 460,000 reads. Today's destination? The intriguing world of Parkway Life REIT. A place where a tantalizing 5% dividend yield is rumored to be guaranteed. Can it be true? Or is it just an investor's mirage? Together, we'll dissect the fundamentals of this healthcare REIT and uncover the reality behind the buzz. By the end of our expedition, you'll be equipped to decide if Parkway Life is the treasure you've been searching for in your investment portfolio. So, buckle up and let's dive right in. Let's start by understanding what Parkway Life REIT is. It's a type of healthcare real estate investment trust, REIT, which was introduced to the public in 2007. This means it's been part of the investment landscape for over a decade, providing a way for investors to participate in the healthcare real estate market. Now, what makes Parkway Life REIT stand out is its diverse portfolio of properties. It owns a total of 63 properties, spread across 3 different countries in Asia. This includes 3 hospitals located in Singapore, which is known for its world-class healthcare system. These hospitals not only provide essential healthcare services but also represent valuable real estate assets in a country where land is scarce. In addition to the hospitals in Singapore, Parkway Life REIT also owns 59 nursing homes in Japan. Japan has one of the world's oldest populations, which means there's a high demand for nursing homes and other types of senior care facilities. By owning these properties, Parkway Life REIT is well positioned to benefit from this demographic trend. Last but not least, Parkway Life REIT owns a specialist clinic in Malaysia. This adds another layer of diversification to its portfolio, both in terms of geography and the type of healthcare facility. So, when we talk about diversification in the context of Parkway Life REIT, we're referring to its wide range of properties spread across different countries and healthcare sectors. This diversification can help reduce risk and increase the potential for stable returns, making Parkway Life REIT an interesting option for investors interested in the healthcare real estate sector. Now, let's delve into the aspects that make Parkway Life REIT particularly appealing. One of the standout features is the exceptional performance of its management team. They have consistently demonstrated their ability to enhance the distribution per unit, DPU, a key metric for REITs that signifies the payout received by each unit holder. For those who may not be familiar with the terminology, think of DPU as the dividends in the world of stocks. What's truly impressive about Parkway Life's management is their ability to grow the DPU without resorting to unit dilution. In the REIT landscape, this is no small achievement. Unit dilution typically occurs when a REIT issues additional units to raise capital for acquisitions or other purposes. While this can lead to growth in the short term, it can also result in a lower DPU because the same amount of income is distributed among a larger number of units. However, Parkway Life's management has skillfully navigated this challenge. They've managed to expand and enhance the REIT's portfolio, thereby increasing the income generated by its properties, all while maintaining the same number of units. This means that the DPU has grown, benefiting all unit holders equally without diminishing the value of individual units. In the world of REITs, this ability to grow DPU without diluting units is a testament to the management's strategic acumen and operational efficiency. It reflects a balance of growth and income generation, which is a key indicator of a well-managed REIT. This remarkable feat is one of the many reasons why Parkway Life REIT stands out in the healthcare real estate sector. Another significant advantage of Parkway Life REIT is its operation within a defensive industry. But what does this mean? A defensive industry refers to a sector of the economy that is generally more resistant to economic downturns. These industries provide essential services or products that people continue to need, regardless of the state of the economy. In the case of Parkway Life REIT, this defensive industry is healthcare. Regardless of economic conditions, people will always require healthcare services. Hospitals, nursing homes, and specialist clinics, the types of properties owned by Parkway Life REIT, are all essential facilities that continue to operate and generate income even during tough economic times. This characteristic of Parkway Life REIT's business model acts as a protective shield, much like a trusty umbrella during a rainstorm. Just as the umbrella keeps you dry, operating in a defensive industry helps to safeguard Parkway Life REIT's rental income. Even when the economic climate is challenging, the demand for healthcare services remains relatively stable, ensuring a steady flow of rental income from their properties. This stability is a significant benefit for investors. It provides a level of income security that is highly valued, especially during periods of economic uncertainty. It's like having a steady hand guiding you through the storm, ensuring that you stay dry no matter what. This resilience to economic downturns is another reason why Parkway Life REIT stands out as a robust investment option in the healthcare real estate sector. Another aspect that adds to the appeal of Parkway Life REIT is the high weighted average lease expiry, WALE, of its overall portfolio. WALE is a measure used by REITs to indicate the average time period in which all leases in a portfolio will expire. A high WALE is generally seen as a positive attribute because it means that the REIT has long-term leases in place. This provides a stable and predictable stream of rental income, which is a key factor for investors seeking regular returns. In the case of Parkway Life REIT, these long-term leases are not just a source of steady income, but they also have built-in protections against inflation. A significant percentage of these leases have Consumer Price Index, CPI, linked revision formulas and rent review provisions incorporated into the tenancy contracts. This means that the rent can be adjusted upwards in line with inflation. This is a significant advantage as it allows Parkway Life REIT to maintain its real income levels even in times of inflation, thereby protecting its bottom line. Furthermore, the management team at Parkway Life REIT deserves special mention for their consistent efforts in generating yield-accretive capital recycling over the past 16 years. Capital recycling is a strategy used by REITs to sell off lower-yielding properties and reinvest the proceeds into higher-yielding ones. This strategy has been effectively employed by the management team at Parkway Life REIT, demonstrating their clear strategic direction and effective execution. In essence, the high WALE, inflation-protected leases, and effective capital recycling strategies all contribute to making Parkway Life REIT a robust and well-managed investment option in the healthcare real estate sector. These factors, combined with the defensive nature of the healthcare industry, make Parkway Life REIT an attractive proposition for investors seeking stable returns and capital appreciation. Indeed, like any investment, Parkway Life REIT is not without its potential downsides. One of the key risks to consider is foreign exchange risk. A significant portion of Parkway Life's revenue is derived from its properties in Japan, and therefore, it is denominated in Japanese yen. This exposes the REIT to fluctuations in the exchange rate between the Japanese yen and the currency in which the REIT's distributions are made. Foreign exchange risk, also known as FX risk, refers to the potential for loss due to changes in exchange rates. If the Japanese yen were to depreciate against the distribution currency, the value of the revenue generated from the Japanese properties when converted back would decrease. This could potentially lead to lower distributions for unit holders. While the decision to expand into Japan was strategically sound from a demographic perspective, given the country's aging population and the consequent demand for healthcare facilities, it does introduce this additional layer of FX risk. It's an inevitable part of operating in multiple countries and dealing with different currencies. However, it's worth noting that many REITs and multinational corporations manage foreign exchange risk through various hedging strategies. These can include the use of financial instruments like futures, options, and swaps to mitigate the potential impact of adverse currency movements. While these strategies can't eliminate FX risk entirely, they can help to manage and reduce it. Now, let's turn our attention to Parkway Life REIT's recent performance in the fiscal year 2023. The distribution per unit, DPU, a key performance indicator for REITs, exhibited a healthy growth of 2.7% year-over-year. This growth was primarily driven by a robust increase in both gross revenue and net property income, indicating a strong operational performance. However, it's important to note that this growth was partially offset by higher financing costs. Financing costs typically include interest payments on loans and other forms of debt, which are a common aspect of REIT operations given the capital-intensive nature of real estate investments. Despite this, the net effect on Parkway Life REIT's performance was positive, demonstrating the REIT's ability to effectively manage its finances and generate growth. In addition to its strong financial performance, Parkway Life REIT also made significant strategic moves during FY 2023. One of the most notable was a $350 million collaboration with IHH Healthcare Singapore. The aim of this collaboration is to transform Mount Elizabeth Hospital into a modern, integrated multi-service medical hub by 2025. This is a substantial investment that underscores Parkway Life REIT's commitment to enhancing its portfolio and staying at the forefront of healthcare real estate. This transformation of Mount Elizabeth Hospital represents a forward-looking strategy that could yield significant benefits in the long run. By creating a multi-service medical hub, Parkway Life REIT is positioning itself to cater to a broader range of healthcare needs, thereby potentially attracting a larger patient base and generating higher revenues. Looking into the future, there are several positive factors that could potentially boost Parkway Life REIT's performance. One of these is the completion of the acquisition of 2 additional nursing homes in 2023. These new properties are expected to start contributing to Parkway Life's bottom line in the fiscal year 2024. This expansion of their portfolio not only increases their asset base but also enhances their income-generating potential, which is a positive sign for investors. Another favorable aspect is Parkway Life's financial position. The REIT has no refinancing requirements until March 2025. This is significant because it means that the REIT has a stable financial footing for the next couple of years, without the need to refinance any of its debts. This stability is further enhanced by the expectation that interest rates will come back down by the time Parkway Life needs to refinance. This could help offset the higher interest rates they might experience in Japan and keep their overall cost of borrowing stable. This financial prudence and foresight is another testament to the strong management of Parkway Life REIT. However, like any investment, Parkway Life REIT is not without its challenges. One of these is the recent depreciation of the Japanese yen against the Singapore dollar. Given that a significant portion of Parkway Life's revenue comes from Japan, this depreciation could potentially impact their distributions when converted back to Singapore dollars. But it's important to note that the management team at Parkway Life REIT has taken proactive measures to mitigate this foreign exchange risk. They have put in place a foreign exchange (FX) hedging strategy with forward positions until the first quarter of 2029. This strategy involves entering into contracts that lock in the exchange rate for a future date, thereby reducing the uncertainty and potential impact of future currency fluctuations. So, what's the final takeaway? Parkway Life REIT presents itself as a compelling investment opportunity, particularly for those who are seeking a stable dividend yield coupled with a high degree of capital preservation. This essentially means that investors can expect a regular and reliable income stream in the form of dividends, while also maintaining the value of their initial investment. Parkway Life REIT's robust portfolio, which spans across multiple countries and includes a diverse range of healthcare facilities, contributes to this stability. The long-term leases and built-in inflation protections further enhance the predictability of its income. Moreover, the REIT operates in the defensive healthcare industry, which tends to remain resilient even during economic downturns. All these factors combine to provide a degree of income stability and capital preservation that is highly sought after by investors. However, like any investment, Parkway Life REIT does come with its share of risks. The most notable among these is the foreign exchange risk arising from its operations in Japan. Fluctuations in the exchange rate between the Japanese yen and the Singapore dollar could potentially impact the REIT's distributions. But it's important to note that the management team has proactively addressed this risk by implementing a foreign exchange hedging strategy, thereby demonstrating their commitment to protecting the interests of the unit holders. Speaking of the management team, they have consistently shown a strong track record of performance. They have successfully grown the distribution per unit, DPU, without diluting the units, which is a remarkable achievement in the REIT landscape. Their strategic vision for the future, including the transformation of Mount Elizabeth Hospital into a multi-service medical hub and the acquisition of additional nursing homes, indicates a clear path towards continued growth and success. So, is Parkway Life REIT a hidden gem or a too-good-to-be-true investment? While nothing in the market is ever truly guaranteed, Parkway Life's strong track record, defensive qualities, and growth plans make it a compelling option for income investors. As always, do your own research before diving in. But if you're looking for a reliable dividend payer with recession-resistant properties, Parkway Life is definitely worth a closer look. If you found this analysis helpful, smash that like button and subscribe to the Investing Iguana for more insights to help you navigate the wild world of investing. Stay tuned for my next video, where I'll be sharing my top 5 REITs for 2024. Trust me, you won't want to miss it. Until then, stay curious, stay invested, and stay awesome. Iggy out.